with chaos at the New York Stock Exchange.
Get back in there at once and sell, sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, August 1st, 2025. Hey, some shout outs to Tom, Debbie, John, Richard, Don, who listens every week, he says. So good catching up with you this week, Don. And everybody tuning in, we appreciate it week in and week out. So let's go ahead and bring you up to speed with what is going on with the markets. And man, is there a lot to cover. So let's go through it. First of all, the numbers. Rough week on Wall Street. Dow Jones down 2.9% this week. The S&P 500 down 2.3%. The NASDAQ Composite down 2.1%. And the Russell Small Cap Index down 4.1% this week. So all major indices taking it on the chin this week. Volatility index, as you might expect, spiked up pretty dramatically, up 36.5%. By the way, folks, a lot of all this stuff happened today. Okay, a little bit yesterday on July 31st, but a lot happened today here on August 1st. We'll talk about the whys in a minute, but this volatility index spiked up big time, 36.5%. Hey, we thought it was looking kind of complacent. We've been saying that we thought that the market could definitely have a step back here at some point. The pain trade has been higher for a while, but it looks like the pain ended today in regards to the market taking a breather. Looking at long-term bonds as measured by the TLT, up 1.6% this week. A lot of money moving into bonds, mainly out of fear. We'll talk about the whys in a moment. And then when you take a look at the different sectors, everything was down and down a lot except utilities. Utilities. So there's some other areas like tobacco, but I don't follow tobacco closely because we're not really investing in it. Tobacco is like a real defensive area because it's really hard to quit smoking, which I know for a fact is I quit back in 2008. And that was one of the toughest things I've ever had to do. Man, that was a tough one. But anyway, the real super defensive areas, mega defensives, up a bit this week. Everything else down a lot, 1 to 6%. I mean, materials down 6.1% this week. A lot of that has to do with copper. Copper getting crushed with the Trump tariffs. Really taking a big hit this week. I think copper was down, I think like 25% this week. May have to start looking at some of those copper miners like Freeport-McMoRan. We made money on that once before. And then looking at gold and silver, gold up 0.5%. Again, some fear there. People run into gold, and silver down 3%. So what was moving markets this week? Well, it was a crazy week. A lot of different things, a lot of moving parts. First of all, earnings have continued to come out, and we had some big tech earnings this week, right? Large cap tech stocks, and the earnings were good. Look, Facebook and Meta, which is what we have in our models, that was the shining star this week. It was up 11% the day they reported their earnings, ended up on the week about 5.2%, but really solid numbers, really pushing into the whole artificial intelligence. Microsoft had a good one. Apple's was pretty decent. Amazon's not so good. I didn't think the number was bad, but it wasn't as good compared to their competitors. So the market punished Amazon a little bit. But all things being equal, the earnings reports are pretty solid. We had pretty good earnings this week, but we had a lot of other things that were making a lot of noise, right? The Fed had their meeting, Jay Powell and company, and as we expected, there were no rate cuts, right? We mentioned last week, we did not expect them to cut rates. We said coming into this year, we didn't expect any more rate cuts until the economy really started to take a hit, until we saw some weakness or some serious cracks in economic data. I think we might have gotten one of those today. We'll circle back around that in a minute. There were two disagreements on the Fed board, two dissents. So Powell didn't have the whole board behind him on this decision. But let me tell you something. Jay Powell was just like showing no indication whatsoever that he had any inclination at all to lower interest rates anytime soon. I think that's going to change come September if the data continues to look like it's looking. But let's just say that Jay Powell was definitely pushing back. I think President Trump kind of hurt himself a little bit. He's coming at Jay Powell so hard. I think maybe Jay Powell would have considered a cut. The Fed board, I think they knew what the number was going to be for jobs. We're going to talk about it in a minute, but Trump coming at Jay Powell so hard has put the Fed chair in a position where he's trying to force himself to look unswayed by the president and by the administration. And I just think he'd be better off just letting the data do the talking. So anyway, market didn't like it. Let's just leave it at that. Market did not like Jay Powell's comments, and it reflected that. And then tariffs, right? August 1st, that is today, Friday, and all the tariffs went into play, and they're ugly, uglier than the market was anticipating. I think the market was looking really for 10% across the board. It got more than 15. The average tariff right now around the world for U.S. tariffs on countries from all around the world, the average is 18%, 18.3 to be exact, and that's the highest it's been since 1934. Highest it's been since 1934. Canada got whacked with a 35% tariff. Mexico, right now they're paying 25% on items that are non-exempt, and that was extended for another 90 days. There's not a trade deal yet with Mexico, but it didn't go up any higher than 25%, but 25% is still pretty high. And then, like I said, their tariffs were just crazy kind of across the board. Average that I saw was like 15, but places like Switzerland paying 39%. India got hit with 25% tariff because Trump doesn't like them buying Russian oil. So there was just a lot of noise there surrounding the tariffs. And listen, I think that can change. I think that you can see positive tariff news come out moving forward, and that could definitely turn the market pretty quickly. Because look, this has been a moving target here since, beginning of the year. No one really knows where we're going to land on some of these things. I think that 15%, though, is starting to come into focus for the market, and the market doesn't like that. It's higher than expected. The market was pricing in 10. The market was figuring 10% across the board, did not get it. And economic data has been coming out this week. Been pretty weak. Things like the manufacturing numbers and all these types of things, just not that great. There was the PCE number. That's the Personal Consumption Expenditure Report, and that is the main inflationary number that the Fed likes to take a look at. That number remains elevated. It just continues to be sticky, hotter than what the market would like to see, and it continues to support the Fed holding steady on interest rates, right? With all this tariff talk driving prices up, the PCE staying sticky, it just really helps to bolster Jay Powell's argument to not lower interest rates. Taken all together, pretty weak across the board, except for GDP. Gross domestic product came in at 3%. Preliminary read for second quarter, 3%, which is huge. And that is definitely not recessionary. Definitely not recessionary, a 3% growth rate. So no recession yet. But that leads me to my next piece of news, and that was the jobs number. And wow, what a doozy. It was ugly. And you can thank the jobs number for the ugly action in the market on Friday. So the jobs number came in at 73,000 for July, well under expectations. But here's what's worse. There was a 248,000 revision to May and June, 248,000 fewer jobs than was originally reported, brings the average down to 35,000 jobs a month over the last 3 months. And look, out of a country with 350 million people and some young folks have just graduated college and digging and trying to get that first job, that's tough. That's not good, right? The market did not like that at all. Look, 35,000 jobs a month is the lowest since COVID, since 2020. That doesn't look very good. And that, on one hand, looks a little rough for the economy, looks a little concerning. On the other hand, the odds for a September rate cut, despite Mr. J, I am not going to lower interest rates, Powell, the odds for an interest rate cut in September spiked to 90% on this jobs number today. The market participants suggesting that, hey, things are starting to crack here and the Fed better make a move. So we'll see what September brings. Okay, we'll see what September brings. Now, before then, the Fed will be meeting in Jackson Hole, Wyoming. They do that every year. And there's usually some commentary that comes out of that. And they usually set the stage for change in direction with Jackson Hole. So maybe we'll hear that coming out here in August. So we'll get the move probably. If the market's going to react to something like that, it'll probably react before the actual Fed meeting in September. And then to add some salt to the wounds of Mr. Market this week, we had nuclear bomb talk between Trump and Russia on social media. So they've been going back and forth as Trump wants to see an end to the Russia-Ukraine war. And nukes were brought up by, I think it was Medved, whatever you pronounce his name, in Russia. And then Trump said, oh, yeah, well, we're moving nuclear subs to the region. And the market did take another leg lower. This just happened today here on Friday. The market took another leg lower when that story broke. But you know what? It did recover from that. It looked like that didn't really rile the market long term. I think the algorithms, the computer trading jumped in, reacted to it, but then settled back down again. A lot of posturing, a lot of peacocking there. A little dangerous, I think, to posture and peacock with nuclear subs and nuclear bombs here, Russia. But nonetheless, that's what was being talked about this afternoon. Oh, joy. Anyway, what have we done this week? Well, we did some selling earlier in the week. So the market's been looking a little rich. It's been pushing higher. In the smaller models, the models under $100,000, the way we manage these at BIG, look, it's difficult to diversify properly amongst individual stocks when you're working with smaller amounts of money. So we use ETF models, exchange traded funds, or baskets of stocks that give you more diversity. It's just a little bit better way to go as far as diversifying the portfolio and having it operate efficiently. Well, we had a pharmaceutical ETF in there that I bought back in the spring. We were up pretty nicely on it, about 15%. But we went ahead and sold that earlier this week because I saw some reports about pharmaceutical tariffs. As a matter of fact, it was Howard Lutnick, Trump's Secretary of Commerce, talking about these pharmaceutical tariffs are going to be coming down the pike. They sound very substantial. I think the pharmaceutical stocks are going to react very negatively to that. So we sold that out of the smaller models earlier this week. And then yesterday on Thursday morning, on the back of that Facebook report, Microsoft report, the market was ripping higher. And AMD, Advanced Micro Devices, that chip stock that we have in our models, it was screaming. It was up over $180 a share. Now, keep in mind, the last round we bought was around $97 a share, end of March. And actually, we go back further. We originally bought this stock a few years ago. $67 a share was our original purchase on this stock. We've trimmed it multiple times. We've added to it multiple times, kind of been in and out to some extent. Anyway, I mean, this thing is up right now as we sit here and speak, even after pulling back after I sold it. It's up 42% year to date. But yesterday morning, it was $180 and change. So we trimmed it back. It went around 180 and 52 cents. It did drift lower right afterwards that afternoon and into today. It finished the week around 170, 190. We did pare it back. Didn't get rid of it. I still think it goes higher. I think it goes quite a bit higher. I think Lisa Su's fantastic. I think it's a great company. It's a well-diversified chip company. But we had a big gain in it, and the stock had become a very large position in the models by percentage. It had become a really big overweight, and they report their earnings next week. I just didn't want to take the chance that the market didn't like something in the earnings and the stock takes a big hit after making all that money. So I trimmed that back yesterday morning. Pretty good timing, thankfully, because the market really took a turn lower. So we got a little bit of cash in the portfolios right now. Look, I think this pressure we're seeing in the market, now that it's finally started, I think it can last a little while longer. I mentioned to you last week, maybe the week before, that August, September, very seasonally weak period of time in the market. And if we're going to see some give back, this is probably the time to see it. So it looks like that's begun in earnest. Maybe that will continue. I think we definitely have some more downside potential, probably down around 6,100 and change on the S&P. It's at 6238 right now. So it's only 1.5% to 2% away from here. That's where I would really be looking to start legging in on some stuff and doing some more buying. I really wouldn't anticipate a much bigger drawdown than that. Even with some of the negativity and the jobs numbers, stuff like that, this stuff is kind of noisy right now. GDP growth was at 3%. Banks are saying consumers are spending money. Earnings have been solid, and the earnings deltas are improving. So I don't think this is it. So I think this is a buying opportunity, and that's what we're going to be looking to do here in the next days or weeks. As opportunities arise, we'll be looking to buy. All you new folks that have come in here recently will be getting your money put to work at these better levels. You've been hanging on to some cash for you for the last couple of weeks as this market's drifted a bit higher. So we'll be working all that in as well. I think we're sitting in great shape. We're really positioned very well. We got some cash on hand to do some buying. And I think what's happening right now, just a lot of noise, very, very noisy, a A lot of things pushing the markets around, and we will navigate our way through that. That's what we're here to do. So I'm going to go ahead and wrap up. That's what I've got for you this week. But between now and next 3 meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe just buy that new house near the lake with a pool. Maybe it is throw yourself a big, awesome 50th anniversary party, Bill and your lovely wife. Hey, you know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.